So, when you're planning for retirement, you're probably already thinking about Medicare premiums, right? It's a known cost. But here's something you might not know. Not everyone pays the same price for the exact same coverage. Let's dive into why that is.
And honestly, this catches a ton of retirees completely off guard. Imagine planning everything perfectly, and then bam, you get this notice in the mail saying you're on the hook for a surcharge, one that can add thousands of dollars a year to your healthcare bills. It can totally throw a wrench in a super carefully planned budget.
So what is this hidden cost? What's it called? Well, it has a name, and it's one that every single person thinking about retirement needs to know. It's called I.R.M.A.A. And trust me, understanding it is the first step to getting it under control.
All right, let's pull back the curtain on this surprise Medicare surcharge. We're going to break down exactly what it is and how it all works.
Okay, so what in the world is I.R.M.A.A.? It stands for Income-Related Monthly Adjustment Amount. Now, the most important thing to get straight right away is that this is not a penalty. Think of it more like a tiered pricing system. Basically, the more income you have in retirement, the bigger a slice of your medical costs you're asked to pay for yourself.
And believe me, the difference can be huge. See, most people on Medicare pay a standard premium, right? That covers about 25% of the real cost for their Part B services. But if your income triggers I.R.M.A.A., you could be on the hook for anywhere from 35% all the way up to a staggering 85% of the true cost. That is a massive, massive jump.
So the big question is, how does the government even figure this out? Well, it really boils down to two things: a very specific way they define your income and a look-back period that frankly catches a lot of people by surprise. The magic number they use is your Modified Adjusted Gross Income, or MAGI for short. Now, for most of us, this is pretty simple. It's just your adjusted gross income from your tax return, plus, and this is a key detail, any tax-exempt interest you earned. Like from municipal bonds.
Okay, now this is probably the most crucial part to understand, the timing. See, Social Security doesn't look at your income today. They use your tax return from 2 years ago. This creates what you could call a phantom income problem, and it hits new retirees the hardest. Just think about it. Your 2026 premium is based on what you earned way back in 2024, which were probably your peak earning years. It's this total mismatch between your old higher income and your new lower retirement income that just catches so many people completely off guard.
All right, let's get into the nitty-gritty. Let's look at the actual numbers. These are the projected income brackets and surcharges for 2026. And remember, this is all based on that 2024 income we were just talking about.
Okay, so this chart lays it all out pretty clearly. If you're filing single and your 2024 MAGI was under about $109,000, you're good. You just pay the standard premium. But look what happens next. As your income crosses each of these thresholds, your monthly premium for Part B just jumps up. And you get hit with an additional surcharge for your Part D prescription drug plan on top of that. And here's the kicker for married couples. Each of you pays these amounts. It's not per couple, it's per person.
And this is where planning becomes so critical. These I.R.M.A.A. brackets, they're a cliff, not a gentle slope. If you earn just one single dollar over a threshold, you get hit with the full surcharge for that entire next tier. There's no in-between, no proration. It means tiny differences in your income can have a really major impact on your costs. Just to put a real number on this, a married couple in that highest income bracket could be looking at over $14,000 in extra I.R.M.A.A. surcharges for the year. That's on top of the standard premiums. I mean, wow. That's a huge expense that you could definitely put to better use somewhere else in your retirement.
Okay, so that's the problem. It sounds a little scary, I know, but here's the good news. You are not powerless here. If you plan ahead, you can actually manage your income and potentially lower or maybe even completely avoid these surcharges.
So how do you actually do it? Well, the name of the game is managing your MAGI. You have to be strategic about where your retirement income is coming from. So instead of only pulling from a pre-tax 401k, maybe you blend your withdrawals. You take some from taxable accounts, some from your 401k, and some from tax-free Roth accounts to stay under a certain threshold. Thinking about a big Roth conversion? Hey, maybe spread that out over a few years. Selling a house or some stock? Try to time it for a year when your other income is lower. And don't forget the real superstars here, withdrawals from Roth IRAs and health savings accounts. They are completely tax-free and they don't count towards your MAGI at all. That's huge.
But what if it's too late for proactive planning? What if you've already retired and that 2-year-old income data has already triggered a high premium? Well, don't worry. There is still something you can do. Let's talk about the appeal process.
Look,
The Social Security Administration knows that this 2-year look-back isn't always fair. Life happens, right? Your situation can change dramatically. So, if you've had a qualifying life-changing event that's caused your income to drop, you can actually file a formal appeal. You can ask them to use your more recent, lower income to recalculate your premium. It's a game changer for many.
So what exactly counts as a life-changing event? Well, here's the official list. For retirees, the most common ones are work stoppage. That just means you retired. Or work reduction. But it also covers big life stuff like getting married, getting divorced, or the death of a spouse. You know, things that can totally change a household's financial situation.
Now, this next part is just as important. You need to know what doesn't qualify. A one-time capital gain because you sold some stock or your house? Nope. A big withdrawal from your IRA to buy an RV? Not a qualifying event. And that strategic Roth conversion we talked about? Sorry, that won't work either. In the eyes of Social Security, these are financial choices, not qualifying life events. So you can't appeal the I.R.M.A.A that they trigger.
The actual process is pretty straightforward, thankfully. It all revolves around one form, the SSA 44. So first, you'll state which life event happened. Then you'll need to provide some proof, like a letter from your old job or pay stub showing fewer hours. You'll also estimate what your new lower income is. You submit all that, and Social Security will review your case. It's really that simple.
So at the end of the day, IRMAA isn't just something that happens to you. It's a variable in your retirement plan that you can actually influence. You can play offense with proactive financial planning, or you can play defense with an appeal when life throws you a curveball. It's a key part of the retirement game, and now that you know the rules, you can start figuring out how you're going to play to win.